Hello and welcome to Money Matters TV. I'm Mike Dever, founder and CEO of Brandywine Asset Management. My co-host today is Jim Butler, CFP and managing director of Marcum Wealth. Hello, Jim.
Hi, Michael. How are you?
Hey, good, thank you.
Good.
So our guest is coming on later. Is going to be really interesting. Doug Bloom. He's just a specialist consultant in small businesses and helping guide entrepreneurs and small business owners. And he's got a really neat presentation for us that essentially unlocks the secrets of creating a successful entrepreneurial company. I think we'll love that.
Look forward
Um,
to it.
yeah. In the meantime, Jim. So we've there's a lot of things happening as we're doing this show that are emotionally occurring in stock market in the US, for example. And I'm getting calls from advisors that have investors in our hedge funds saying, hey, investors want to know how much protection do we have in place? If the market melts down, are we going to be okay? Questions like that. And you're starting to feel that little bit of nervousness and panic happening. We've been in the business long enough to see that often when that's happening. Maybe it's not going to melt down now. It's at a turning point. But the main thing is what we find is that investors that make decisions under emotional duress like that are almost always wrong in whatever it is they do. You comment on that or thoughts on that?
Well, timing of the market is near impossible. And those who profess that they're able to time the market are, I think, misleading. And really, for the vast majority of investors, we just don't have the patience or the ability to predict what's going to happen to the weather tomorrow, much less the market throughout the rest of the year. So, trying to time things, I think, is really a fool's errand.
Yeah, and the data really shows that. In my book, I published my Jackass Investing. Don't do it. Profit from it. In that, in one of the opening chapters, we show that the investors underperform the very funds into which they invest by as much as 5% a year. That's all due to timing. They rush in at the top and they panic out at the bottom.
Right. Yeah. Yeah. And the reality is that bear markets, which are defined as, market drawdown of 20% or more, occur about every 5 years. If you look back over the past, say, anywhere from 25, 30, 40 years in the market, and using the S&P 500 as a guide, it's common. At the same time, while the market dips to that extent about every 5 years, about within any 12-month time period, within the calendar year 12-month, the market dips on average 14, 15%. That doesn't mean it dips and ends up down 14%, but there's a lull in there typically in any given year. So, if we look at the recent past, 2024 was a positive year, 23 was a positive year, 22 was not, 21 was, and so on and so on. But yet the long-term averages, still hold to be about, somewhere in the 10 to 11% range for the buy and hold investor.
Yeah, it's going to be in line with, if you have corporate earnings growth, stocks follow that over the long term. The stocks are going to go up. In the meantime, you've just got emotion that drives it. And really all that does for you is provide opportunity. If you're certainly a young investor, you're not withdrawing from your funds, you're accumulating funds. You don't want the market, going straight to the moon the second you start investing. You want to be accumulating. And so you got to think of it as an opportunity rather than something to get nervous or, on panicky even, about which we do see at times.
Yeah, no doubt. I have something real quick that I read recently right along these lines, and it really, the title of it is The Life Cycle of the Headline du jour. And headlines is what a lot of people, react to. And so stage one, Mike, is a news story becomes the focus of investor market attention. Stage two is we greatly overweight its long-term importance. Stage three, we develop shallow expertise and a passable opinion on the subject. Stage four, we calculate our overexposure to the issue. We think we have more exposure to it than we really do. Stage five, we inaccurately predict how financial markets will be impacted. Stage 6, we will either make a poor decision, as you just said, or have to justify not making one. Stage 7, we move on to the next in the spotlight news story. And then stage 8 is the best of them all. We entirely forget what we said in stages 1 through 6 within a few months. So
Yeah, that's is how it happens. And I've seen these cycles over my past 40 years, multiple times every year. I mean, is it tariffs? Oh no, let's panic about tariffs. Is potential war here, or, inflation. I mean, it is constant. There's always a worry du jour. You got to sit there and panic over or not. And for the most part, people want to be active and do something. And I had a friend that his favorite comment was, if we went go skiing to get to the top of the lift and figure out which way to go down, and everybody's standing there going, wow, let's do something, even if it's wrong, and that's almost the mentality that people want to have all the time. Do something, even if it's wrong. Where with investing, what's been proven over and over is often to do nothing. One of the studies that's been out there, I've seen a number of times, is women versus men, and there is a difference between gender, where women tend to outperform the men. And why is it? The men trade 4 or 5 times more frequently than the women do. They're more aggressive and want to do something. Everything points to, when you're ready to panic, have a beer and forget about it.
Right. At the same time, as advisors, we have to be sensitive to those emotions. People have concerns, and they're valid concerns. So, I spend time listening and empathizing because it's the world in which they live. So I try not to say, we're right, you're wrong, because there is no right or wrong. Mm-hmm. It's really looking at history as a guide.
Your job as an advisor is, I've always did. We're fund managers. We're trading funds. We don't do anything that's really interacting with the actual client that much, but we'll interact with an advisor like you. And, what I see your job, I mean, aside from all the financial planning and structuring, estate planning, and everything that you do, but on the investment front, it's mostly a psychologist kind of job, psychiatrist, I guess, hand holding, keeping them stable. On my end as a fund manager, what I do is try to minimize what you need to do by creating products where, if the market's down 30%, maybe they're down 15. They might still be down, but try to mitigate the downside, so it makes it a little easier for people to sleep better at night, and stay invested.
Yeah, I agree. Good points.
Yeah. Yep. Now I have a viewer question for you here.
Okay.
This is Jerry Welton from Philadelphia. With an IRA conversion to a Roth IRA, is it really worth it, since you have to hold the money in the Roth for 5 years before you can use it?
So the answer, Mike, and actually Jerry, is that oftentimes it does make sense. And the reason has to do with, I believe, the benefits that a Roth brings to the table. It is true that the Roth needs to be in place for 5 years. And oftentimes you actually have to be 59 and a half in order to pull money out on a tax-free basis. But we frequently will even look at Roth conversions for clients that are in their 60s and 70s, because the advantages are: 1, tax-free growth; 2, tax-free withdrawals; and 3, tax-free withdrawals, Mike, not only for the investor's life expectancy, but if it gets passed on to their beneficiary, whether it's their spouse or their kids. So money coming out of the Roth always is tax-free, and that's a huge advantage. So one solution that we will provide as an option is, if you have, just pick a round number and say $100,000 in an IRA, maybe instead of converting the whole thing, you convert a portion of it. You could convert, say, $25,000 in 2025. That becomes includable in income this year. So you do pay taxes on it going in, but the tax-free growth over time again, assuming you leave it in there for 5 years and ideally even longer, then I think the benefits far outweigh the give up and the tax liability that you pay on the front end.
Okay, very good. Thank you very much, Jim. Uh, okay, so if you would like to send a question in to Money Matters TV, here's how you can do that.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
Okay, thank you. Now we're ready to move on to the star of the show and introduce and bring on the show Doug Bloom.
Hi, guys.
Hello, Doug. So tell us briefly a little bit about DAB Ventures, what that means, what you're doing.
So for the last 30 odd years, I've been involved with entrepreneurship as a private investor, as a venture investor, as a venture-backed CEO, an entrepreneur in corporate America, an outright entrepreneur, starting a business from scratch with some friends. And it's all culminated. We sold the business I was running in 2016, the end of 2016, and in 2017, I was looking to see what's next. And a lot of people are saying, you have a coaching style. Have you ever thought about coaching businesses? So I started coaching businesses in 2018. It took me about a year to get organized. And since then, in 2023, I was looking for a community of fellow coaches, and I joined the Pinnacle Business Guides community, which is a community of top-end former EOS, former scaling up coaches, and some entrepreneurs like myself who've come to the world of coaching. Today, I coach a handful of clients. My colleagues coach anywhere from 5 to 20 clients depending upon their service model of how often they touch the clients. We focus on bringing clarity to the entrepreneurial challenge. We tend to think of entrepreneurship or business as having black and white answers, and really everything's gray. And we need to make form and structure out of the gray. And how do we do that? We do that by creating vision, driving clarity around that vision, getting the right people to join us on a mission, and identifying roles, responsibilities, targets, goals, metrics, and holding each other accountable.
Okay,
Hey,
so
Doug.
now, go ahead, Jim.
Doug, when a business owner reaches out and simply says, I need to get some outside advice, and you're sitting down having a conversation with them, what are some of the things that they should start focusing on as they walk down this path?
Well, the back of my business card says, "Is it lonely in the corner office?" And you guys look at the response you guys both have. I mean, you both have either laughing or go, "Oh God!" Like sometimes you hand the card to somebody and they look at it, read it, and it looks like you shot them in the chest. You just kind of concave. But the point is really what they need to focus on first is, why am I doing this at all? It really comes down to what's the purpose? What are you trying to achieve for yourself personally, for your family, for your legacy, and then within the marketplace, what are you trying to achieve? So the first conversation we have is a conversation around, what are you trying to achieve? What's your time frame? Jim, in your space, you probably work with a lot of business owners who are looking for an exit at some point.
Right.
Well, exits are weird because 40 to 60% of all businesses, depending upon who you talk to, that look for an exit just go through liquidation. They never make it to an exit, a transfer of ownership or transfer of assets. And why is that? Because the businesses are intrinsically not sellable. You might have a hero-centric CEO, everything runs through that CEO, and the business doesn't exist with the CEO. The business might not have a customer base which is universal. The business might have a customer base which is tied to the nature of the CEO and the relationships with specific customers. So you end up with businesses which are not sellable. You end up with businesses where the entrepreneur is straddled to the business. They haven't developed a team. They haven't developed differentiation amongst their customer base or differentiation amongst their suppliers and their vendors. They're dependent upon specific customers for specific skills. They haven't recorded their SOPs and their job descriptions and track metrics on a regular basis. So somebody buying the company doesn't know what they're buying.
Now, you have a bit of in our talks, and I've known you, Doug, decades now. You have a sort of a cheat code for identifying what companies succeed, why they succeed, which you can use as selecting companies, finding, and advising on the areas they really need to concentrate, I think, to really build out their value. Is that correct?
Well, it's a little bit different. Pinnacle Business Guides is an operating system, a business operating system. And just like any computer operating system or any systemic set of instructions, there's a process that you can go through. There's different tweaks and changes. When I first started, I've been a Pinnacle Business Guide for the last few years. When I first started out, I actually thought, what am I going to coach on? What are the factors I'm going to coach on? It just can't be head trash all the time. We got to figure out what factors correlate with success in the business world. And since I was looking at businesses and worked most often in businesses that are in the six-figure top line growing to seven-figure top line, I went to one of my buddies who's an A-round investor as a venture capitalist who's been successful over the last 30 years and said, how do we look at this? So what I came up with is, let's look at your most recent exits and look at the factors that were present in all these companies at time of investment, rate them, and see which of those factors correlated with success. And we have a little presentation on that.
Oh, great. Let's take a look.
So next slide, please. The question was, what factors are predictive of higher venture return at the time of investment? And so we're really looking at how do we have some sort of prediction of future performance? Once again, this is everyone's panacea. You guys are just talking about predicting the market. Well, this is predicting a business outcome. Next slide, please. I'm sorry, next slide. So we looked at some factors, came up with a model of saying there's external factors, there's factors centered around the senior executive, the CEO, and then there's some cultural factors that could be visible and demonstrative. Please, next slide. Measures of success that we thought would show in the rearview mirror if the team functions with process and rhythm. The team is productive, manages cash well, predictable results. All these types of high return of capital ratio. These are all factors that we thought might show in the rearview mirror. And the high return of capital is the one we said was the most demonstrative of venture success. Next slide. The experiment, I talked to with my one buddy who is a Northeast-based A-round investor. 24 investments which he completed recently. We looked at some forward-looking factors. We rated the factors 4, 3, 2, 1. There was no forced rating. Next slide, please. I'm not going to bore you with the definitions. I'll get to them as we go. Nor all the data we collected. I'll get to that as we go. But what happened? Pareto's principles happened. Of the 24 investments, 5 of them have yielded more than 80% of the sum total return. So you can't escape Pareto's principle. Whether you're hiring people, managing salespeople, you guys looking at your clients who provide the most revenue for you, and all the business owners out there, you guys know the Pareto's principle. Your A players provide 80% of the results. Your A customers provide 80% of your revenues. The best vendors are the ones you do most of your business with. It's human nature. The results factors, as you would expect, generally process, rhythm, productive team, cash managed well, consistency and results. Those are all high performer outcomes. So as expected. What was interesting, the higher scores also have the highest return ratios. That's as expected. If you're a high performer, you're a high performer. So nothing new there. Keep going, please. What happened was what we looked at is we looked at specific factors which correlate versus total sums of all the results. What are these results actually correlated with cash on cash return? And as we can see, the market pull, I'm going to explain what these. Market pull is an external factor. And what market pull means is, does your product fit the market in such a way that there's just amazing market demand for your product? It doesn't mean you're not necessarily in a commoditized product. You could be in a commoditized product, but your service delivery and your customer relationships create a market pull. But if you're not feeling market pull is the driver of outcome in the business. The
And here you're saying, Doug, this is that you have your product, you put it out, your service, whatever it is, and people come to you. You don't have to necessarily
people come
sell
to
it.
you, or your marketing results have greater impact than marginal.
Mm-hmm.
So if you market once and reap twice. I mean, I was in the company we sold in 2016, where when we first started the company, we could close business in one phone call. But then we had large competitors come in who were better placed than us, and they competed with us. We were not in a position to pivot, so we ended up selling the company. But if you're in a commoditized business, a business where you're competing and you're being commoditized, basically your margins are being squeezed by your competition, then you've got to pivot. Because if you don't pivot, all you're going to do is work harder, not make as much money, and not have any fun.
And pivot mean essentially go to find the service or product that has the pull.
Listen to your customers, identify what's necessary. Yeah, and exactly as you said, go to the service, which is you're going to realize pull. If you're in a competitive business and you can protect margins and you're just competing, stay focused and compete. Focus on the customer segment, which is going to drive the most results for the marginal cost of competing. If that makes sense.
Mm-hmm.
So these are the sort of conversations I have with clients. And Jim, to your question, where do we go? We don't get there first day, because first day is aspirational. But then how do we actually realize the aspirations is through a process of looking at the business systemically. Next slide, please. I'm sorry, Jim. Go ahead.
Doug, what are some of the maybe common obstacles that pop up that cause a delay or inertia? It's just hard for business owners to either start on or stay on the path that you're referring to.
Well, it's a great question. I think it's my own personal bias is that people drive just about everything. So the level of self-awareness that the CEO has about how much they are, poor choice of words, but it's the reality, interfering in the execution of the business. They have to really do a hard assessment of their team. If you think of the team on a 2x2 matrix, the matrix being productivity going on the horizontal and culture fit going on the vertical. And if we map them properly, then the A players are in the upper right-hand quadrant. They're high on culture fit and they're high on productivity. The people below them, in the quadrant below them, they're kind of the toxic, I don't want to say the word, but they're kind of the toxic miscreants who are highly productive people, but yet they ruin the culture with every touch. Mm-hmm. They got to go. The people that are in the bottom left, they neither get culture nor productivity. They shouldn't be let in the door in the first place. And the people in the upper left who fit the culture but aren't productive, you got to coach them up or possibly coach them out. If we fail to create an environment where A players feel like they've arrived, then A players will leave, and the A players drive your business. So I think it really comes down to the not being clear about who you have in the business, which is interfering with the business, not understanding when you yourself are not interfering, when you or yourself are interfering in the business, not setting a clear, purposeful vision. Without a clear, purposeful vision, your vision-oriented A players are going to leave, and also not setting expectations or not following up with expectations. I think from a personal level, inconsistency in message and action will actually drive a lot of people away as well.
Is there? So we've so far, again, we've only got a handful of minutes, unfortunately, but we talked about the product service and having that be pulled, and now we've talked about the people that are going to execute on the business and make it happen. Is one more important than the other, or can you succeed?
Everything comes with people. If you have a great team and a bad business plan, and you give them the opportunity to innovate, they'll fix it. If you have a second-tier team that and a great plan, they won't be able to implement it. Your A players look for hard wins. They go after the hard things to do and do them well. Your A players will fail smart. They'll come to you and say, I'm not going to be able to get this done. What do you want me to do? The B players will go for the easy wins. The C players won't go for wins at all. If I can just kind of conclude, there's 5 factors or 6 factors that we need to look at. We need to look at the market pull. We need to look at the CEO building a team. We need to look at the company building a culture that people can buy into. We need to look for accountability across the board, a financial acumen, because accounting is the language of business, and if we're not speaking the language, we're not at the table. And then finally, the kicker on all this is when you do the numbers, that those companies which showed those factors as high had an 8 times cash on cash return. That means that as a multiple of cash in and cash out on any one investment, those companies had 8 times the return that the companies that did not have those factors. So if you're an early stage investor or an early stage operator, if you focus on those 6 or so factors, accountability, financial acumen, culture, team, market pull, you focus on those factors, and I'm not sure I've had 5 or 6 there, you're gonna probably win in the long run. So that's the secret sauce, Mike, if we're talking about it.
Are you able to give an example? Do you have somebody you coach through that?
Company was 2 guys who had a business service business. Met them at a meeting that somebody else was running. They said, "What do you do?" I said, "I coach businesses." They said, "We need a coach." They were sub $1 million, probably 600,000, maybe 700,000 total revenue at the time. We did a heavy dive on writing SOPs. We did a heavy dive on culture, behaviors, and visioning, long-term vision, long-term where they want to be aspirationally. And we ended up, they're now probably doing about 4 million and change a few years later. They have the challenge of going beyond. There's 4 stages of business development. First is just getting your business off the ground. The second is getting repeat customers. The third is sustainability. And the fourth is big time scale. There's a growth that goes through those phases that the role of the CEO is different at each one of those phases. They're a champion in the first phase. They're building a team in the second phase. They're focused on profit in the third phase. They're focused on scale in the fourth phase. Helping a company grow through those phases. And Mike, you've been through this, and Jim, you probably have as well. You have to change your stripes. You have to start delegating. You have to figure out what you need to do. I mean, we focus on delegation. We focus on what should you be doing. What do you need to let go of, even though you might be great at it? Those are the type of conversations we have with CEOs. I don't know if that helped.
No, that was great. How would people find you? Just go out to do a Google search your name, go to DAB Ventures?
Yeah, dabventures.com.
dabventures.com. Well, Doug, I thank you very much. I mean, obviously this is a topic it's so deep, and I'd love to hear more examples and go further on it, but this is all we have for today. I really appreciate you coming on and sharing with us.
Thank you. Thank you for your time, guys. Appreciate it.
Thank you, Jim, for your help on the show and co-host. We'll look forward to seeing you again next time. So our next guest on Money Matters TV is Drew Yancey, PhD of Telios Strategy. Thank you for watching Money Matters TV, where your money matters. See you next time.